Trade Observer of the Air, and I am Jim Grant. As always, that's true, right?
Most of the time.
And with me, as always, is Evan Lorenz, the great deputy editor of Grants. Henry French is at the control panel, and yes, we have a guest today, and not just any guest. We have Jim Bianco himself, James Bianco, the eponym of Bianco Research in Chicago, somebody who knows more about the bond market than what? Alexander Hamilton, who basically invented the American wing of the bond market. I happen to have gone through college with Hamilton at Columbia, and he thinks about Jim Bianco as we do, which is a sage. Jim is the fellow who knows more about the numbers than most economists, and more about the way the market works than most investors. And the two of them together, he is one formidable figure. So, Jim Bianco, welcome.
Wow, that's a very nice intro. So thank you very much.
Yeah, well, it is from the heart and from the head equally. Here we are on the Wednesday before Thanksgiving, and I think it would be churlish to begin on a bearish note, but bonds aren't your thing. Is that so, Jim?
Yeah, I've been going around giving a lot of presentations. I was in Europe last week, and most of the people there were bullish on bonds. So I started by saying something that I'm sure was never heard in the halls of Grants. Hi, my name is Jim and I'm bearish, is the way that I would start all of my meetings. Basically, the 40-year bull market in bonds ended in 2020, and we're in a multi-year bear market in bonds. You can have a couple of year rally in there along the way. I don't think we're quite ready to do that yet, but I do think that rates are going to continue higher. Or to put it in your terms, Jim, there are interest rates to observe, and there's going to be more interest rates to observe as we move forward from here.
Well, I think both of us, we were at the receiving end of an existential threat to the business model of interest rate observation. And came a little personal around here, too, I must say.
We also found out that during that period when you had your existential threat, that zero wasn't even a floor for interest rates. And, Sidney Homer's book, didn't even contemplate that when he looked back to interest rates to Mesopotamia.
Yeah. Well, Irving Fisher did, one of the great interest rate theorists of America. And he had a couple of paragraphs on the theoretical basis of 0%, sub-zero rates. But Irving Fisher never said that you would accumulate more than $16 trillion worth of them, as actually happened, I think, in the year 2021 or something.
Yeah, it was 2019. And actually, I was looking at those numbers recently. They just ticked off zero just in the last couple of weeks. A couple of very short-term bills in Japan went back negative. That's all we have left now on the planet in terms of zero interest rates. Or negative interest rates, excuse me.
Has there ever been a greater evidence of excess? I mean, there are kind of flash mob incidences of excess in all speculative markets, right? From tulip bulbs on. I guess there's some scholars who say the tulip bulb thing was actually well considered. But let's use tulip bulbs as a literary or a metaphorical thing. So these kind of flash episodes occur persistently, episodically. But I'm not sure that anything has been so excessive at such a considered length of years as was the phenomenon of negative nominal yields. And whether that's true or not, I don't know. But what do you suppose, Jim, it signifies so far as punctuating a cycle? Is this the thing that people look back on and say it didn't happen because it couldn't have?
Oh, no, I think that you're right, that this punctuated a cycle like we've never seen before. And to this day, people are still having a difficult time understanding that, let's call it the 2009 to 2020 period, or in terms of the U.S. market, the QE period.
Yes.
And they're trying to figure it out because when I said, my name is Jim and I'm bearish, one of the retorts you'll hear from people a lot is, boy, rates have gone up a lot. And they're at 15-year highs on real rates. We're at 23-year highs on mortgage rates. They've gone too far. And I was like, well, you've got an anchoring problem. You're coming off of that extraordinary disconnect of that 2009 to 2020 period. Those were the rates that were incorrect. The rates that we have now if you go back and you look at history and you go, what were the average interest rates before 2009? They're pretty close to what we have right now.
Yeah, 5 or
So this,
6% is kind of the average American interest rate going back to the founding of the country.
right. And so this isn't even a new normal. This is just returning to what they used to be before
Yes, right.
before the QE period. And no less than the average economist in the United States is struggling with this, because what is the consistent call been for the last 5 or 6 quarters, excuse me, is we're going to have a recession. Now, I happen to subscribe to the Bernanke theory about recessions that, expansions don't die of old age, they're murdered. So something has to murder the expansion, and eventually something does. They always do. But the perception is that that murder weapon has been higher interest rates, and it hasn't come to pass because, as you pointed out, 5-6% has been the average. That's pretty much where we're approaching with rates. They haven't gone high enough to break anything yet. And since they haven't, that's why we continue to see the economy perform better than we think. And that's going to lead, I think, to ultimately even higher rates. And eventually we'll get to that point where either the murder weapon is interest rates or it's oil. Those are usually the two most commonly seen murder weapons, or financial crisis like we saw in 2008. But one of those will eventually come down the pike and murder this. But right now, the idea that the consensus on Wall Street is that the current level of interest rates is that murder weapon, I don't think is quite there yet.
Yeah.
If the economy is murdered by higher rates, what signs do you see? And in recent weeks, we've actually heard a number of kind of negative anecdotes, like subprime auto delinquencies are the highest ever, at least going back to like the early 90s. We've had Walmart, Wendy's, Target, Home Depot come out and talk about a weakening consumer. It seems like some things are slowing despite the fact that we're getting really still good economic numbers overall. If the economy is going to die from higher rates, what does it look like and what are you looking for?
Yeah, so, let's keep in mind that the third quarter GDP, and I just look at GDP as just being an aggregation of all the statistics, was very strong. So we're seeing some slowdown from that. And yeah, anywhere in a $30 trillion economy, you're going to find problems, whether it's in delinquencies here or housing there, the consumer here or manufacturing there. There's always going to be some issues. But to your question, what is it that will tell you that we're really on the precipice of breaking something? To use the Wall Street parlance, risk markets. When we break something, the last thing you want to do is own stocks. You don't want to own stocks in the process of breaking something on the idea of, oh, good, everything's going to hell, so lower interest rates means that I should be long stocks. It's, oh, good, everything's going to hell means I got to get out of the riskiest of assets, which would be something like equities. So since the equity market seems to be having no problem with this, since the corporate credit markets don't seem to have a problem with this, I kind of conclude that we're not there yet in terms of having that murder weapon, exercising itself right now.
Jim, the government would seem to have a vested interest in lower rates. It is, of course, a massive net debtor. It is a collector of capital gains taxes, and it is a bank regulator. And as to the third item, bank regulation, a scholar at the American Enterprise Institute, Paul Kupiak, is just out with an analysis. He looked at bank call reports as of June 30th and found that something like 2,300 or 2,400 banks holding about slightly more than half of the assets, total assets in the banking system, were marked to market on a leverage ratio basis, and they showed less than 4%, which is a threshold for corrective action, the brand of being significantly undercapitalized. So the banking system is still kind of not teetering exactly, but it is bearing the burden of a very, very quick return to something like normal interest rates. So the question to you is, might the something that hypothetically, prospectively will break, might that thing be the thing that would seem almost to have been discounted, namely difficulties in the banking system having to do with unrealized but still real losses on fixed income securities?
Oh, yeah, there's definitely that. I mean, the banking system, just to, support what you were saying, the bank stocks have been not only among the worst performers this year, As I like to joke with the banking industry, that you could sum up the banking industry as JP Morgan in various levels of suck is basically what is what you see. And as you get to mid cap banks, small cap banks, they do much worse and worse. It is going to be a real problem. But not only is it the worst that we've seen this year, if you go back to the financial crisis in 2008, 2009, of the 11 sectors in the S&P, the worst performing of those is the financial sector. And the worst industry within the financial sector has been the banks. It's been about the worst place to be in the last 15 years. And that's been a big sore point for value investors, because a lot of value investors kind of instinctively hit knee, leg goes up, keep gravitating towards financial stocks all the time because they see compelling values. And of course, there's a reason that these stocks continue to have compelling values. And now the newest problem they're having, their old problems used to be with regulation, but now their newest problem, you're right, is with higher interest rates. And so they are teetering on this problem. So I'd say to you, that's a great place to look for the murder weapon, would be if the banking industry or the banking system seems to have a problem. And I might also add within that, there's a new twist within the problems that the banking system are having, and it's been relabeled as the bank walk. And that is not a run, but that is people are starting to realize that their banking accounts, especially if you have one at Chase, your deposit accounts are yielding you somewhere near zero, and the money market accounts are yielding you somewhere north of 5%. And why don't I move my money? Well, prior to 2008, moving your money was an arduous task. You physically had to go to the branch and fill out paperwork. And as I like to joke, wait a week and find out it was filled out incorrectly and go back and fill it out, wait another week, then the approval comes through, then you transfer your money, wait 3 days, then you could put it in a money market fund, and no one did that. Today, you pick up your phone and you could transfer your money in 5 seconds. And that's what the bank walk is this relentless deposit outflow that we're seeing from the banking system. So really what's happening with banks is they are pulling back on lending, and they are pulling back on a lot of their activities. And really where that's hurting is in the bottom half of the economy. What I mean by bottom half, the companies that don't have the scale that they could go to the credit markets to borrow. So large cap companies that could just file a 144 and issue a bond, either be high yield or investment grade, they can get still very attractive terms. But if you're a smaller company and you need to rely on borrowing from a bank, those terms are not very attractive because of the problems that the banking system is having. And I think that's going to continue to be. And then you throw in on top of that, this whole remote work phenomenon is really got office real estate in a bad place right now. And 75% of all commercial lending in the United States has been done by a regional or small bank. It has not been done by a money center bank. And so they're sitting with mortgages on half-empty buildings. As you said, no one's in Manhattan today. No one's in any office today in the United States. And the problem with Monday is they're only going to be about half full on Monday, which is why you're seeing a lot of office real estate struggling. So no doubt the banking industry is one of the weak spots of this economy right now. And it's one of the things that I've been focused on as far as a potential murder weapon for the economy. But I don't think it's quite there yet, or at least it hasn't quite murdered it.
You said in terms of looking for when the murder actually happens, you're following the stock market. I think the S&P is up 18% year to date, but you've pointed out that most of those gains are from 7 stocks, and you've done an analysis on the top concentration of 7 stocks in the S&P 500 going back to, I think, the 50s, and there's never been a time when 7 stocks have accounted for more of the market than they do today. So what does the market tell you when breadth is so narrow and so much is concentrated in so few?
So a couple of things. You're right. The Magnificent Seven stocks are 30% of the S&P. I got the data going back, decades and decades, and I believe that to be the highest percentage that we've ever seen from 7 stocks. Well, for whatever it's worth, AT&T did hit 11% of the market cap of the S&P in the 1960s, and Apple's at 7.5%. So that's about the only record we have not taken out yet at this point. The 18% gain in the S&P, about 14 or 15% of that is those 7 stocks. And the other 493 stocks are accounting for somewhere between 2 and 3% of the gain in the S&P. And I'm talking on a year-to-date basis here. They're underperforming cash, those other 493 stocks collectively, as far as their influence on the S&P. So I have two takeaways from that. The first one is interest rates matter. We used to talk about TINA back before 2020. There is no alternative. Today, there is an alternative, and it is a 5.5% money market fund. Dr. Jeremy Siegel updated his book, Stocks for the Long Run. A new edition is out this year. And in it, he says that the long-term return for the stock market through all cycles up and down is about 8%. Well, if I'm going to get 5 to 5.5% without any market risk in a money market fund, I'm getting about 2/3 of that gain. So what is it worth to take that risk to get the other 1/3? And a lot of people are concluding it's not. So there is an alternative. So you could tell me about the stock market and you go, great, it's returned 0 over the last 2 years, bad in 22, good in 23. But I'm getting most of that away from the stock market with very little market risk. So there's that. And the second thing I think that's happening is because of higher rates, and because of the Magnificent Seven, they have a theme around them or a narrative around them about artificial intelligence. Now, we could argue whether that's a valid theme or not, but I also think that we are finally transitioning away from the era of index buying. Everybody just buy the S&P 500 ETF. That's all you need to do. All the boats go up, and there's your investing strategy. And if you want to get nuanced, we could go into a 60-40 portfolio, and we put 40% of your funds in the bond market ETF. To good old-fashioned Peter Lynch stock picking. I think that era is starting to return. Now, there's two issues with that. One, a lot of people are going to nod and go, yes, stock picking is coming back. And I would argue 90% of them that are nodding have never had to do it. And we don't know whether they can do that. And so it's a whole new set of muscle skills that have not been exercised on Wall Street for a long time. And we'll have to see whether or not we can do that without, the cramps and the aches and the pains along the way of trying to figure out how to get back to a stock picking era. Or Peter Lynch can come out of retirement, because it seems like we've got the Peter Lynch era starting to return. And so I do think that one of the reasons that we are going back to a stock picking environment is because we are in what I've referred to as a post-COVID economy. I think a lot of trends have changed about this economy. The economy has evolved in ways that we don't understand, whether it's remote work, it's deglobalization, it's energy as a political weapon. And a lot of things need to be restructured, need to change because of that. Change does not mean dystopian. And that means that there's going to be specific winners and losers in this post-COVID economy, not general winners and losers. So it's not just, I'm bullish on energy, just buy the energy ETF. It's which energy stocks. And that's something we haven't had to talk about for a long time.
Which reminds me that I want to say a nice word about our sponsor. Well, since 2007, SRS Acquium has been obsessed with a single purpose: to simplify the administration for M&A deals so that deal parties and their advisors can focus on bigger issues. SRS Acquium was a pioneer in professional shareholder representation, digital M&A payments, and online stockholder solicitation. And they continue to raise bars and set industry standards. Case in point, their new VDR, which is changing the way deal parties think about virtual data rooms. The more tracking down thumb drives are asking how the VDR bill got so high. SRS Acquium keeps deal documents securely stored on the cloud for as long as you want for one flat rate. And working with SRS Acquium means you get the simplicity and stability of a single best-in-class partner for that pitch book through that last dollar out. 50% of U.S. private equity firms and 40% of venture capital firms worldwide count on SRS Acquium to optimize how their deals get done. To learn more about SRS Acquium and how is it simply the smartest way to run a deal, head to srsacquium.com. That's ACQUIOM,
Yeah. So, Jim, the latest things, the hottest things in sliced bread now is private credit, which is non-traded loans, usually funding highly levered transactions, usually private equity buyouts. Private credit has taken off, and the proponents of private credit actually believe that private credit is going to actually take over the overregulated banking lending. They point to the fact that in the summer, Ares bought a $3.5 billion portfolio of consumer and business loans from PacWest. And these weren't high yielding loans. They were just standard auto loans or real estate related loans. And that private credit's going to basically fill in the role for bank lending going forward. How does this kind of complicate the picture of looking at banks as kind of the barometer of the economy and kind of the health of the financial system?
Well, it definitely does because, one of the stats I gave you before is that, what is the worst sector and the worst industry within that sector since 2008? It's been the banking system. And I think the takeaway from that has been that the market is signaling that there needs to be a disruption and a change in the financial system. And it's coming at it in a lot of different ways, whether it's crypto, it's fintech, or it's private credit, that the banking system has become such a public utility and now an over-regulated public utility with its cost of goods being interest rates going up, that it's finding itself in a very poor place to compete. So fintech is probably going to be the place that we're going to go for innovative finance. It's no longer going to be the banks. Crypto might be the place that we're going to go for payments. That's still years away right now, but we seem to be, or at least digital assets might be the place where we were going to go for payments. And that's still years away. And where do we go for lending? And it might wind up becoming private credit. Now, the problem I see that private credit's going to have is there's one place that's got a big vested interest. It's the Eccles Building in Washington, or 33 Liberty Street in Lower Manhattan. They have long viewed the primary purpose of the banking industry to be lending. Whenever you ask about any innovation in the banking industry, they seem to look at it from the point of view is, what does this mean for banks as a credit intermediary? And they want the banks to continue to be the credit intermediary because then they regulate the banks. And if you were to take that credit intermediation out of the banking system and put it into private credit or somewhere else, I think the Federal Reserve is going to have a word to say about this somewhere down the line. So I get the move towards private credit. I understand it and it makes sense. But there's a bureaucracy that's eventually going to stand in the doorway here of this and try and change it or alter it or stop it or something along those lines. And that's merely looking at the history of the Federal Reserve. Whenever there's any times there's been any kind of in money market fund in the 1970s, the Federal Reserve was dead set against that because they saw it as a threat to the banking system and they saw it as a threat to them being able to regulate the banking system. So I think this is just a continuation of that trend, that they'll have a word to say about private credit at some point when it gets to that critical mass that they start to worry about it.
Jim, the tempo of this bond bear market that may or may not lie ahead of us is, of course, of great interest to people. It makes a lot of difference whether interest rates go up at 1% every 10 years or 1% every 5 months, as they seem to have done since the bottom and only a couple of years ago. Amazing acceleration of rates since 2021, say. We've only had two bond bear markets since the turn of the 20th century. The first one, 1900, 1920, it took long bond 10 years to move 100 basis points up. And second bond bear market, 1946 to 81, it took 10 years for the long-dated treasury to move from 2.25 to 3.25. So here we are, and say it's the third bond bear market of modern history. And the movement from like nothing to 5% was, 18 months? So what does the future, what does your technical work and what do your instincts tell you about the likely tempo of rising rates in the fiscal quarters and years to come?
So you're right that this has been completely unprecedented. At Macquarie, Santa Clara University has got data on the bond market back to the 18th century. I think 1793 is when his data goes back. And what we've seen in the last 2 years or 3 years has not only been the worst bear market in terms of losses in total return ever, but it's not even close to that what we've seen before. So why has these losses that we've seen in the bond market been so much greater than everybody else or any other bear market beginning? Why such a big move? Because of the huge distortion that we had going into this bear market, and that was 12 years of money printing and $16 trillion of negative interest rates. And that we were a lot of what we saw in the beginning, a lot of that 500 basis points was just undoing that mistake. And like I've said earlier, I don't even think we've even overshot yet at this point. We were just undoing a terrible mistake that we saw happen. And so I guess what I'm going to see from here is that we'll have probably a more standard random walk with the bear market. It will overshoot first, undershoot second, but then kind of zigzag its way higher. Those undershoots, otherwise known as counter trend rallies, could last a year or two. One of the reasons, talking about, the technicals in the market and why I said, hi, my name is Jim and I'm bearish, is the overwhelming majority of fund managers today seem to be very bullish on bonds. The overwhelming majority of fund managers 10 years ago were very bearish on bonds. The mistake they made 10 years ago was, the Nassim Taleb famous quote from 2010, every human should be short bonds, was right 12 years later. It was they had the idea right that bonds represented no value because of the extraordinary actions of quantitative easing and money printing to force interest rates to an unnatural level. But it stayed at those unnatural levels a lot longer than anybody thought. They all thought it would be a period of a month or a year before it would correct. It took, till 2020, 2021 before we saw that start to correct. Well, we did a lot of that now with the worst bear market, but I do think now we're going to have to start to see for rates to go on the overshoot. So I expect that, the 10-year yield, probably middle of next year, might go to at least 5.5. That's where I think fair value is. Then we'll have to see whether or not inflation has settled down enough for the Fed's liking and for the market's liking to stay at that 5.5%. If inflation stays problematic, and let's call that above 3.5% on the long run rate of inflation, we might have to see them go higher on interest rates in order to really start to slow things down. Otherwise, we could stay at that 5.5%. But ultimately, if the question is, when is that year to 18-month counter trend rally? I don't think it's going to come when you've got, the Bank of America Global Fund Manager Survey showing the highest level of bullishness in the 21-year history of that survey. When 80% of managers surveyed by Wall Street are saying that interest rates will be lower or bond prices higher in 1 year. That is almost a universal belief. So we're probably going to have some kind of capitulation on that view. And maybe that comes with this whole idea that there isn't going to be a recession, and we'll have to review that. And then we could probably start a counter trend rally. And so I still think that we've got a ways to go on the upside for this stage. And then maybe we could start talking about a decent counter trend. But the longer trend is, I think we're returning to an inflationary environment similar to what we saw, the way I've defined it, between 1968 and 2001. That was an inflationary environment. Now, you might say 2001, there was no inflation in the 80s and 90s. Yes, but we were worried about inflation and we were relieved there wasn't any. So we saw a rally in stocks and bonds. But right now, I think we're transitioning to a period where we're worried about inflation. And before we can have that real relief that we don't have inflation, I think we're going to have to see at least a capitulation on the view that everybody's long bonds right now and everybody's bullish. And the consensus call is the recession is 2 quarters away, and it will probably always stay 2 quarters away because I don't think we're going to get one right away.
So even if there's a mild recession, could that actually have outsized impacts on the financial markets compared to previous ones? And the reason I ask is, in 2007 through 2009, the Fed took rates to zero, started QE. We also had the TARP Act, which was $700 billion. We had the American Recovery and Reinvestment Act, which was, I think, over $1 trillion. We had a united Congress and monetary policy to stimulate. In 2020, when we decided to shut down the economy, the Fed kitchen sinked monetary policy. We had an alphabet soup of different bailout bills, and we got the stock market to recover all of its losses within a few months. But going forward, we have a Congress that is so divided that they struggle to pass a short-term funding bill. We have a Fed that's probably not going to cut rates to zero, at least right away, because they still need to kind of, reestablish their credentials in fighting inflation. If we don't kind of get this kind of monetary and fiscal boost, if there is even a mild recession, could that, I guess, surprise people to the downside?
What do you mean by surprise them to the downside? You mean interest rates fall a lot more than?
Well, I
people
think
expect?
the expectation is if there's a recession, we're going to get a lot of fiscal stimulus and a lot of monetary stimulus. Suddenly, bonds go down, and all long duration assets like money losing tech stocks go up, and that's great for the markets. But if that condition's not true, could it actually lead to, I guess, a worse hit to financial assets than I think one would expect?
Oh, yes. Oh, yes. I mean, what I think you run the risk of is in the next downturn, if we get Wall Street's favorite forecast, that is the soft landing. The B of A survey said 75% are predicting a soft landing. And I quipped, it's the perfect Wall Street forecast because there's no definition for a soft landing. So I predict something that has no definition. I could therefore define it later on to tell you why I was right, as opposed to a hard landing, which is a recession that has more of a definition. Or to stick with the metaphor, no landing just means a continued expansion, which is what we've seen for the last several quarters. We know what that is. And so it's harder to redefine that. But if we get some kind of a soft landing or a mild recession or something like that, or something that approaches what people think that means, again, it's not defined. The Fed is going to be in a or financial markets, the Congress and the Fed, I don't just want to implicate the Fed, might be in a very difficult spot. If I'm right, we are transitioning to an inflationary period. Any type of answer of, oh, we've got to cut rates massively, we've got to see fiscal stimulus, maybe even NQT, maybe talk about doing more money printing, that could produce a toxic reaction in markets, because if the concern is inflation, if we are in an inflationary period, the response by markets is going to be more inflation, bad. So as you try to fight this recession, you're just going to make it worse if you overstimulate. You were able to get away with that in 2018, 2019, and even through the pandemic because the concern was deflation. And so no amount of money printing is going to make anybody worried about inflation when the fear is deflation. And to that end, I think you're starting to see this in a subtle shift in the market. Now, Jim, you've been around longer than me, and I can never remember the last time that the quarterly refunding announcement became a thing. I mean, I know professional managers that didn't even know there was a quarterly refunding announcement because it wasn't ever that important when it came to the trend in the market. Well, if you look at what is really driving it, Stephen who works at Bloomberg now, did a PhD dissertation on this at the University of Michigan in 2018. And in it, he found that if you look at the stock bond correlation, that explains the times that supply bothers the bond market and supply doesn't bother it. When the stock bond relationship is above zero, meaning that the correlation is above zero. That's what I meant to say, stock bond correlation. Stock bond correlation is above zero. That means stocks and bonds move up and down together. What is that environment that they move up and down together? That is an inflationary environment. They're worried about inflation. It's bad for both. They either both rally when you don't have inflation, or they both sell off when you do have inflation. In that environment, supply matters. That there's a very tight relationship between the supply that the Treasury issues and, say, term premium. In a period where the stock bond correlation is negative, which is what it had been from 2000 to about earlier this year, there's no relationship with supply. So you find yourself, if you look at 2020, 2021, when the CARES Act passed, when we had a $4 trillion deficit, 18% of GDP, and we were just blowing all the records away in terms of issuance of bonds, 10-year yields stuck at 1%. Nobody cared about supply because they weren't worried about inflation. But today, at much less supply levels, we're all mesmerized by supply because we got the causation backwards. We are transitioning to inflation, and it's inflation that's driving the theory or the fear that's causing supply to be the problem. So it's inflation is the cause, and the effect is supply.
Yeah, I think there's a lot of truth there. I mean, in the 1980s, during the Reagan terms, yields were sawed in half as the public debt tripled. I believe those are the figures. But in the 1970s, Jim, supply was in fact a thing, and the quarterly refunding was a point of focus perhaps because of inflation was a driver, but still supply seemed to matter, as it subsequently did not matter in the least. But I wonder if there could be a return to concern about what the old folks would call the public credit that has not been, as you say, a thing in basically in our lifetimes, mine being rather longer. But the idea that the United States, gifted as it has been with a reserve currency, could ever have to worry about the condition of its finances, of the public finances, that's been a talking point, but it's never been a substantive investment point. And I remember when Reagan, or you perhaps read about it in grade school, Jim, but when Reagan got on the television in 1981 and said, all you have to know about our financial troubles is the public debt has just topped 1 trillion. 1 trillion. So what is it today? It's more than that, right, Jim?
33 trillion.
So here's my question. Is it possible that the country, that the United States government examined as one would, like the city of New York? The city of New York is a credit sensitive operation. You wouldn't know it from the way the bonds trade, but still, it can't print its own money. Is the United States coming to be regarded worldwide as a credit sensitive issuer? And is there a ceiling on the public debt?
So not now, but coming soon. I think there's a lot of people politically that would like to see the U.S. dollar lose its status as the reserve currency. And if that would ever happen, and you just recently had a BRICS meeting in South Africa with Brazil, Russia, India, China, and South Africa, talk about finding an alternative to the dollar as the reserve currency. The only problem or the benefit that the dollar has is there is not an alternative to it. There is no other bond market that can handle the level of payments, or which runs in the trillions a day, or the rule of law, or the ease and comfort of trying to do transactions in dollars on a global basis. If you were to switch to any other currency, frictions go up, costs go up, transparency goes down, and rule of law becomes, depending on where you go, a lot more questionable. But that's not to say that the dollar is safe forever. It's not going to be safe forever. As soon as an alternative shows up, my guess is it will be some kind of digital alternative, but we might still be many years away, maybe even more than a decade away, before something like that comes up. And the reason I say that is I just don't see it being the euro or the yen or any other fiat currency that could possibly take its role. And it's certainly not going to be the Russian ruble or the Saudi dinar or the Chinese yuan. Those are just from a rule of law standpoint. I don't think anybody would accept those as far as a reserve currency. So the U.S. has this, exorbitant privilege. So just staying in the 1960s, I think they coined that phrase. And because of that exorbitant privilege, credit has not been an issue for the U.S. But inflation can become that issue in lieu of it, as we see massive money printing, fiscal irresponsibility. So yes, the U.S. doesn't default, but your dollars just become worth a whole lot less because of inflation, and just printing more and more supply means that the price could go down. So I don't think we're quite there yet, but we will get there. And finally, the history of this is, if you look at any country that runs into some kind of a credit problem with their sovereign, it is never, ever that politicians will get responsibility to fix it. It is that the financial markets will impose a discipline on them and force them to do something about it. The latest example of that was last year in the UK. So Liz Truss, there's a trivia question for you, who was the prime minister when the Queen died. It was Liz Truss for 49 days. She proposed a mini budget, and Parliament was okay with it, but the gilt market was not. And so the gilt market, to riff off of Paul's favorite line, the gilt market did the work that the Parliament wouldn't do, and it set about to kill the mini budget, which was going to cut taxes, increase spending, and make a bigger deficit. So in 8 days, in September of last year, 30-year gilts went up 150 basis points. The Bank of England's got 300 years of data. They've never gone up 150 basis points in 8 days. That got the effect that the market wanted. It killed the mini budget. It brought some fiscal responsibility to Parliament, and it also had unintended consequences. As you remember the famous meme, Liz Truss didn't last as long as a head of lettuce. And so she was out very quickly. So this is how you wind up. If there's going to be a credit discipline that needs to be imposed, or there is a limit on deficits or government spending, it's not going to be, oh, if we just elect these politicians with this viewpoint, that this will fix the problem. It's almost never that. It's the financial markets will lean on you so hard and put you down on your knees that you have no choice but to take a fiscal discipline that you otherwise wouldn't, because it will force it on you. We saw that last year in the UK.
Jim Bianco, thank you. My name is Jim Grant, and I'm bullish on Jim Bianco. That's how I'm going to introduce myself from now on. So thank you for being with us, Jim. Thank you, Evan.
Thank you.
Henry, well done. And ladies and gentlemen, happy Thanksgiving. Or I hope you have had a happy Thanksgiving. And we'll talk to you soon on behalf